Hello, everyone, and welcome to Hayes' Higher Learning. My name is Ashley Hayes, and I am so excited about this week. This week, we're talking about one of my favorite subjects, which is money. We're going to talk about investing, life planning, insurance, and everything in between. And I have invited a very special guest, Ryan Walker. Ryan Walker is a financial advisor with Edward Jones. Edward Jones is a full service investment firm. He's been working with Edward Jones since June 2011. He's originally from Northern California, but wanted to go to an HBCU, and they don't really have that in the West Coast. So he decided to move down south and attended school at Tuskegee University in Alabama, where he studied both finance and economics, then moved to the Atlanta area after graduating. His office is in Roswell, about 30 minutes north of Atlanta, and he's a second generation financial advisor. His father works for the firm as well. Ryan, welcome to the show. Thank you so much for being here.
Thank you, Ashley. I'm very, very excited about today's conversation. I've spent a lot of time thinking about what today may be like and the topics we may go over.
I'm excited. So you and I have an interesting story about how we connected, and I like to share that with our audience. So my godfather, who was on a recent episode, has worked with your dad, who's been a broker for over 30 years. And I know my godfather credits him with like so much of his financial security, and he decided to retire early and was able to do that. What inspired you to get into the business, and why is helping people invest and plan for the future important to you?
Well, ironically enough, I wasn't initially inspired to get into the business when I was younger. Although it was what my father did, I think fathers have become really clever these days. For a long time ago, the situation may be, hey son, one day you'll pick up the family business and you'll pick up and start to do whatever it is that I do. But I feel like fathers have gotten clever over the years, and instead of kind of insisting or encouraging their children to follow the footpath, they kind of just give them the options, and it's just kind of there if you want it, but if you don't, that's fine as well. So initially, even from the time that I went down south to attend Tuskegee University, even as a freshman, I initially started as a freshman as an undecided major, not sure what I wanted to do or what I wanted to be. At some point in time, Edward Jones recruiters actually came to my university. They bought pizza. As a broke college student, if you come and you buy his pizza, you've got our attention. And they told us about the Edward Jones opportunity and what it was like to be a financial advisor and some of their history. And as again, broke college student, I'm sitting there. I'm a millennial, like a lot of us are, and a lot of millennials are really looking forward to being entrepreneurs. They don't want to work in corporate America, working for a boss or working for someone else. They kind of want to have their own setup. So the more I heard about the Edward Jones opportunity and being a financial advisor, the more I realized that it's a perfect mixture of a 100% do it all yourself and a 100% working for a company that does it all themselves. As an advisor, you're set up one advisor in each office. You've got your office, you've got your name on the front door, you have an admin, you guys work together and you're a branch team. And the more I listened to the opportunity to be in control of my own future and set, the bar where I wanted to, the more attracted I got to the idea. So I remember I had already successfully secured a summer internship with Edward Jones before I even told my family about it. And by the time they knew about it, I did a second internship, and then I came on board with them immediately once I graduated Tuskegee. So that was kind of the story of how I got here. Now that I'm here, one of the things that inspires me the most is I kind of had an idea that I can kind of help people that aren't familiar with investing and aren't aware of how investments work. I kind of had a feeling that I could tap into a few of those markets and kind of bring education to a few different groups that don't necessarily have access to that. And I think I'll talk a little bit more about that today because that's kind of coming to a forefront literally right now.
Absolutely. And that's a very interesting story. And I like your point about dads because I just told Ed I think I'm going to law school next year. And it's like, he didn't push me in that direction, but now we've arrived here. So that's always a good moment
they do a good job of being role models in the sense that you realize you want to be like them, and then By the time you realize what you're doing, you're halfway through a career path. But I would,
Exactly.
and
And
I
you're
will say
here.
this,
Uh-huh.
similar to yourself, of growing up and hearing those stories from Ed, I grew up and heard some similar stories from my father. And it's funny because whenever I hear the story and I ask, like, what did Ed do or what was your relationship like? I don't know if Ed has told you this or not, but Cedric basically just says Ed made it easy. All he did was he listened, he
Mm.
took the advice, and he was very disciplined with his saving and with his spending. And because he was good at his saving and his spending, he didn't ultimately need much. He was just very disciplined with his approach.
Yeah, he has. So he's like, I did what Cedric said. I gave him my money. And I think that now I'm like, I'm gonna do what Ryan says because I definitely trust you.
It's a working partnership. It's a
And
partnership.
absolutely, but it's working well. And I'm curious, Ryan, how early do you think people should start saving for the future?
I almost want to say there's no right or wrong answer. There is definitely a right and a wrong answer. The right answer is as soon as they can. Kind of going back to the Ed thing, at the end of the day, saving or investing or preparing for any financial goal, whether it's taking a trip out of the country or buying a new car, requires one of two things: time or money. If you have both, great. If you got a lot of time and you got a lot of money, great. You'll probably hit your objective pretty easily, but you don't necessarily need both. You just need one or the other. So, in regards to how soon or how late is it to, there's definitely a such thing as too late to invest. And we'll kind of talk about that a little
Mm,
bit because it's not the funnest. But in regards to too soon
hmm
or how early, there's no such thing. The sooner a person starts investing and the more they take advantage of time, the less money they'll need. So
mm,
if a person does not take advantage of time, then they're going to need a lot of money. And
a lot of
yeah,
money.
and
Hmm.
it is really the question really should be is how much money do you want to have to save and how much time or time crunch do you want to put yourself in? So I work with a lot of people, everybody from younger individuals to middle aged to elder folks. Usually some of my folks that are a little bit elder, they're kind of saying some of the same things that they wish they had started sooner and they wish they had taken advantage of more time. I have clients in their early 30s that put away $50 a month. And
Hmm.
$50 a month isn't exactly enough to retire off of, but when you think about $50 a month, 12 months in a year, 20 or 30 years worth of doing that, at some point in time, they're going to earn more income. They'll probably start to increase how much they save. Once you see your investment account or your investment portfolio, and you see that it's growing, it's like a feel good moment where you want it to grow more, and it's not really a specific how much do I need to be saving. That there's no right or wrong answer in that regards, but usually it's a how much can we afford to comfortably save without impacting the quality of life. So a lot of times
Because that's a
it
thing.
is. It is. And a lot of times, especially younger individuals that don't necessarily have as much money, they have a lot of time, they're a lot of the times feeling like they can't save right now because they have to pay for other things and they don't want to impact the quality of their living. And this is kind of where you hear the old additive, invest in yourself before anyone else. So it's kind of like a good idea to utilize the strategy of as soon as you get paid, put money aside out of your paycheck and then live off of what else you have after you save. And sometimes the only way to figure out how much you can comfortably afford to put away in savings is you got to sit down, look at what are you spending, what do you need, what do you not need, and then make a decision what could you comfortably put away.
And talk to me about the too late, because that was the other part of my
Oh,
question. Is it too late?
so the too late is it's kind of like one of the moments when you're with your doctor.
Mm,
Um, and if you have something that they can't necessarily fix, they could just make it better. They can make it more comfortable. Sometimes we have clients that don't work with us as soon as they should, simply because they feel like it's a daunting conversation if they don't feel like they've made the preparation sooner rather than later. And sometimes they're kind of expecting I'm going to have to work forever. I'm never going to be able to retire, or I'm going to work until the day I die, because a lot of times they're thinking or feeling in the back of their heads,
Mm-hmm.
I didn't save for retirement. I didn't do what I was supposed to. I know what I've got saved away or put in, in the bank, and I know how much I spend. And at some point in time, things are going to get ugly, and they don't literally stick their hand in the sand, but it's a very easy conversation to avoid if you're not feeling like it's a conversation that you want.
Absolutely.
So sometimes we sit down and I'm going through their numbers and I'm looking at their financial situation, and sometimes it's all a numbers game. It's not an opinion.
Mm-hmm.
It's not a
They're there,
perspective.
yeah.
It's a number. The numbers crunch the way that they crunch, depending on how much we plan to spend in retirement, how much time we have between now and then, how much we earn, how much can we comfortably afford to save. All those components go into it. And sometimes, if the client just started too late or they didn't save enough, sometimes it's like, all right, well, we are going to have a shortfall. We're going to start to run out of funds at this point in time. But you know what? Actually, the best silver lining in those situations, and they're not often.
Mm-hmm.
8 out of 10 times when we're working with somebody, we're able to help avoid all of that.
Mm-hmm.
But sometimes we catch people that did. They started saving a little too late, or they just spend a little bit too much. But the silver lining in those situations actually is we get to sit down and say, all right, let's say we're 55 and we're looking at retiring in 60. We've got 5 years left. We didn't do a great job of saving and preparing for retirement. We've got a little bit of time left. And in this situation, maybe we need a whole lot of money, but we just don't have access to it. We can, at that point in time, kind of take control of our life and plan and say, okay, well, we're planning to retire in about 5 years, but maybe we work 6 or 7 or 8 years. Maybe we work a little longer. Or, we were planning on spending $5,000 a month while in retirement. Maybe we don't buy so many cups from Starbucks, or
Mm-hmm.
maybe we don't go on so many, vacations or travel. And instead of spending 5,000 a month, which is 60,000 a year, can we get it down to 4,000, which is 48,000 a year, or 3,000? If we can't get the spending down over the next 5 years, can we save more?
Mm-hmm.
And it doesn't necessarily have to be one of the three. It could be a combination of two or all three. But at that time, we basically get to customize the rest of our investment process of, do we want to try to work a little longer? Do we want to try to save a little bit more now between now and the timeline? Or do we want to try to spend a little bit less while in retirement? And again, we may use all three. We may use two others. I may have a client that says, you know what, the way my back is working, my back is killing me. I cannot work 6 years. We got to stop it at 5. All right. Well, we're not going to work longer. Can we save a little bit more? Can we spend a little bit less in retirement, or can we do both?
Mm-hmm.
But usually the silver lining, which isn't, necessarily the coolest thing ever, but it's valuable nonetheless, is what type of plans do we want to put in place to make the situation as good as it can be,
Mm-hmm.
outside of let's just show up to retirement and whatever's the case,
That's the
it
case.
is what it is.
Yeah.
Yeah. Yeah.
Yeah. Like getting a grip over something, like at least trying to do what is within your power.
Right. Which kind of goes back to the point the question you asked earlier about, is there such a thing as too soon? And really the answer is no. I mean, the best way, same thing as if you're planning a trip, right? It doesn't have to be retirement. If you're planning to go out of the country and we're, somehow living in a non-pandemic world, if you're planning to take a trip out of the country, say November 1st, all right, we've got about a month and a half, well, a little bit closer, 2.5 months between now and November. You got a time frame. If you start to save for your trip now, you've got a good amount of time, 2.5 months, you've got plenty of time. If you wait till 2 weeks before November, if you didn't take advantage of time, you're going to need to start saving a lot more money, pretty tough. And if you find yourself in a situation where we just never took the time to figure out how long are we going to be on the trip for, how long are we going to be out of the country,
Mm.
how many days, how much money are we going to spend, how much money is the flight, how much money is the cost of the stay. Once they get there, do I want to shop and do I want to
Mm-hmm.
buy things? How much money is it going to cost me to eat? I don't want to be out of the country on a budget eating, whatever,
Right.
whatever
Noodles
I can get my hands
insane,
right.
right?
Noodles, right. I want to go somewhere. If I'm in France, maybe I want to. I don't know, go eat a steak or French fries. I don't know what the case may be, but just it gives the individual an opportunity to customize the rest of their experience and take control, so that they don't get hit or caught off guard, if that makes sense.
Yeah, it makes absolute sense. And so, Ryan, what would you just say to someone who says that they can't afford to invest because maybe they don't make enough money or they feel like they need to pay off debt first or whatever the case may be?
So that's another great question because it's not uncommon. In fact,
Mm-hmm.
I'd say it's to some degree common. I mean, we have a lot of folks that say I can't afford to save, and really that goes back down to the same process of we need to figure out what are we spending our money on, and we need to figure out what do we need and what are we able to let go
Mm-hmm.
and
Prioritizing.
prioritizing. And then at the end of the day, the question really is how important is retirement? How important is the goal? Well, the goal, everybody's goal isn't necessarily retirement. It may be saving for college education for their kids or for their grandkids. It may be saving to pay off a house or saving to pay off a car loan. If the conversation is, I don't make enough to save for this goal, the question turns into, well, how important is the goal?
Mm.
If,
I
if
see.
it's not, I mean, it's there. There's a lot of shared responsibility and the partnerships between an advisor and their client. And the advisor can come up. The advisor is not the person driving the car,
Nope.
right? It's not, and sometimes I think that that's kind of the feeling, but the advisor is the guy that's in the front seat with the driver, asking the driver, where do we want to go? Driver says, I want to go here. The advisor in the front seat holding the map says, all right, I've plotted out a course to get us from point A to point B. You said this is where you want to go. I've got the course. Let's go ahead and drive there. And if at some point in time we make a wrong turn or we make a left when we should make a right, or if we get off on the wrong exit or whatever the case may be, because life will happen, the advisor is the guy that's supposed to say, hey, let's do this so that we make sure that we get back on track. And my GPS says we'll be there in about 45 minutes and we're going to get there right at 3 o'clock. Does that work out for you?
Mm-hmm.
That's the advisor.
Mm-hmm. I like it. I like it. And it is such a valuable thing to understand that you have power too. Like, I know for me, that was the thing where I'm like, oh, I just send Ryan my money and he does something with it. But you really engaged me in the process. And I'm like, no, it's your money. Let's talk about it. I have some plans, I have some ideas. And I think that that's so valuable. So I think in the age of Twitter, right, we have a lot of accessibility to information. And I see a lot of conversations about this idea that financial workshops or education itself is a remedy for poverty. Come to this financial workshop, read this book, read, Rich Dad, Poor Dad, or Get Rich Quick. What is the role of income, though, in wealth building? Can someone attain financial security without substantial income?
Yep. Yep. Shit can happens all the time. So that pretty much directly comes back down to self-discipline. Ironically enough, in my role, what I see the most is that individuals that retire with a large amount of retirement resources didn't necessarily have a high income.
Mm.
They were just disciplined with their saving. And the flip side of that token is a lot of times individuals that do have really high income, they didn't necessarily do a great job of saving and they don't have as much retirement resources. Obviously, that's not always the case,
Mhm.
but a lot of times it is. A lot of times, individuals that just earn high incomes, they have high spending amounts, they're kind of spread thin and they've got a lot of liabilities. So they've got a really big house and it's very expensive. They
Mm.
got really great cars and they fly out of the country and they buy their kids all of the best and they put them in all the sports. And it's more often than not, what you hear from books like Poor Dad, Rich Dad, and from other books of the sort is to live below your means.
Mhm.
A lot of times individuals with the higher amount of income don't necessarily feel like that applies to them. So I guess I say all that to say this. You don't have to have a huge income. You just have to be disciplined with your approach to investing. And I will say that it's interesting because going back to the point that I was trying to kind of allude to earlier, there was something in me as an individual who notices when it comes to financial advisors in the industry, they traditionally kind of look one type of way.
Mm.
They don't necessarily look like me or like you. And
Mm-hmm.
the industry as a whole is changing that. So one of my responsibilities at Edward Jones is to find other diverse individuals like us and try to help recruit them because we're wanting more diverse individuals because that's the way of the world. But taking it to the client's perspective, that's the same thing as a while ago, most investors used to look one type of way.
Mm-hmm.
And that's changing also. And one
Mm-hmm.
of the things I wanted to do was I wanted to help facilitate that change. And years ago, when I first started working with Edward Jones, I felt like I could bring education to some communities, financial education to some communities that don't necessarily have it or aren't necessarily familiar with it. And a few years ago, I wasn't very successful with that. Just, I think the timing may just not have been right, but for whatever the reason, during this pandemic, I noticed two large groups that are kind of having like an awakening moment. One of them is millennials,
Mm-hmm.
and the other is diverse people, pretty much as a whole. And specifically, what I mean is the Robinhood apps, the Acorn,
Mm-hmm.
all of the apps and all of the new technology. I've had so many conversations and so many questions from about March till now about how to get invested. Is now a good time to get invested? I heard on the news that everybody's getting invested, or I have a friend who bought a stock and he's made money and whatever the case may be. And it's like it's a huge awakening moment for millennials and for diverse people as a whole, to where I'm seeing so many of my peers and counterparts that went to HBCUs or that live in the Atlanta area. They're getting invested. They're talking, just like you said, they're asking questions about life insurance. They're asking questions about stocks and Roth versus traditional IRAs and how much do they need to be saving. I mean, we've gotten the most referrals in the last 4 or 5 months than we have in the last 4 or 5 years, and that's a big deal.
Wow, that is a big deal.
Right. It's a big deal. So like the pandemic is giving the opportunity, but there's a huge amount of groups that are just wanting to know more knowledge and know more information. So this is a pledge that I've made to myself and to my community. I'm not necessarily looking to start doing business with everybody or to open up an account for everybody who wants to open up an account. We do have an ideal client, but I do want to be a pillar of information and share whatever knowledge I have about investing and about things that are important for newer investors to know. I literally just want to be a beacon of information. So anybody that has questions about stocks or has questions about how do stocks make money or which stocks they should or shouldn't be investing in and why, they don't have to have an account with me. We don't have to be doing business. There's no cost or anything of the sort. I just want to share whatever information I have and answer whatever questions anybody may have about the investment world as a whole, because I realize right now there are so many questions and I don't want those questions to be answered by some other individuals that don't have as good of intention. I want the
Mm.
information to be genuine, true, and accurate.
And I think I very much appreciate that. And one of the things I teach at Hazel's High Learning is taking responsibility in our community. And I think that is so dope. So if you're listening and you have questions for Ryan, you can leave him a voicemail on the Anchor app. And I know that I have sent Ryan text messages. I'm like, Ryan, I got a question. And let me tell you, he's a nice guy. But I think you make a good segue into this conversation about like the apps. Is there a benefit with working with a broker versus just, investing a little bit or doing the rollover investments in the apps?
Yeah, yeah. So they're two completely separate worlds. They're tied by the investment component, but they're two completely separate bags. That's I would say think of it as I'd say think of the apps as you call, let's say you have a plumbing issue or an electric issue in your home,
Mm-hmm.
right? So you do what everybody does, you call the electrician or the plumber, whatever the case may be. And when the electrician gets there, I'd say you between the time that you called him and the time he arrived, you watched a video on YouTube and you're like, hey dude, I got this. I know you're here now, but I know you're here now. You're in my kitchen, but let me borrow your hammer and your drill.
I got this, right?
I got it. I got it. I checked some things out. I know what to do. I
I
know you
watched
went to school.
YouTube. I
Yeah,
listened to,
yeah,
I read all the Nipsey Hussle book
yeah.
list. you know.
Yeah, I asked a buddy of mine. He said, "This is all you got to do. I've got it down packed." Mr. Electrician, I know you went to school. I know you were trained for this. I know you had to get legally certified to do this, but forget all of that. Not important. Give me your drill. Give me the saw. I've got it. I saw how to do it.
Hmm.
And to some degree, in some cases, that may work. I mean, if we're talking about putting in a light bulb or, painting a picture, that may be easy. But again, if we're talking about something like an electrician, I mean, you could shock yourself. We're
Hmm.
dealing with electricity here. It's not a joke. Or same thing, if you're, doing something with plumbing or whatever the case may be, you could seriously damage this house if we make an error or make a mistake. And that's what it is like when it comes to financial planning. Again, whether it's retirement planning or saving for college education or whatever the goal may be, life insurance, whatever it may be, it's easy if we're just talking stocks, especially with the market we've been in over the last 10 years or so, from about 2008, 2009, since the last time we had that, financial meltdown, if you will, or
Hmm.
recession, if you will. The market, for the most part, has been on an up and up, almost directly up to the right bull run. Very, very large amount of growth over the last couple of years. I mean, I actually was cleaning out my home recently, and I found a market update, just a weekly update that Edward Jones we print and we share them with our clients. Back in 2014, that said that the Dow had closed around 16,000 points. Today it's around 27. So from
Mm.
2014 to 2020, it rose from 14,000 to 27. It's on its way to doubling. I mean, 28,000,
Wow.
14. It's right. It's a big deal. So long story short, um, the whole idea of using an app to help with stocks or investing is great for the experience. I encourage all of our clients. I've had clients that have said, "Hey, I want to buy this, I want to buy that." And I may say, you can't buy that at Edward Jones. Like we
Mm.
literally cannot buy it. And keep in mind, we've got a whole team of analysis.
Hmm.
They'll analyze the company, they'll analyze how they put together their investments. And if we don't feel like it's a suitable product for our clients, we will say we can't buy it. There are some things that we can hold, but we can't buy. There's some things we won't even hold here.
Mm.
So sometimes I'll get a call from a client who's like, "Hey, I heard this stock has doubled or tripled in the last, week or so. And the return sounds really great to that person, but they're completely stepping over the fact that anything that has a return has a direct amount of risk. So
Hmm.
they may
Absolutely.
they may hear that it's doubling or tripling and they want a piece of that, but they might not realize that they could lose a lot of money also. So that's what the app is it allows you to dibble and dabble in a bunch of things and you don't necessarily have the help of anybody else besides you who's ever in your own network. I will say this though. For the person that just wants the experience of buying and selling stock, those apps are a great platform for that because it's way more affordable to do that on that platform because a lot of times they don't even charge you per trade or maybe like $5 per trade.
Hmm.
Working with the financial advisor, you're going to probably pay more per trade, but it's a more comprehensive conversation.
Hmm.
I'm
I
not a
see.
stockbroker. I'm not a stockbroker.
Hmm.
I follow stocks and I'm into stocks, but stocks are just a tool in the toolbox. So whether we're talking about stocks, bonds, or mutual funds, I'm here to do a job and get the job done. And within my toolbox, I don't really have a preference or a favorite of which tool is my favorite. It's whichever tool do I need to get the job done. So within my toolbox is more tools than just stocks, but the online apps or the apps that we have on our phone a lot of times are just a stock trading platform. They're a lot of times skip over mutual funds and bonds and the whole ability to comprehensively sit down and plan. Like I was saying earlier, how much do we earn? How much do we spend? How much can we comfortably afford to save? All right, now that I've got a plan for retirement, do I need to have a plan for my kids or saving for my kids' college education, or do I want to pay off my life insurance? You know what? The the women in my family, they a lot of times they get a certain type of cancer, or the men in my family a lot of times when they get around a certain age, they have a lot of strokes. How can I protect me or my family or the people I care about from these unpredictable type of events? Well, an app's not going to help you with that. I know
Mm-hmm.
Robinhood's not going to help you realize that if you're talking between a man and a woman and they're married or whatever the case may be, a lot of times when I'll ask the husband, I'll say, "What's the most important thing to you? What's the biggest financial objective I need to be aware of?" They'll look me right in my face and they'll say, "My wife." You know,
Mm-hmm.
if something happens to me, I want to make sure that she's taken care of.
Mm-hmm.
And the app's not going to help you plan for that. The app's not going to help you say, "All right, well, sir, if anything happens to you, what we'll do is we'll buy a life insurance policy. But we'll have one for your wife as well, to where if something happens to her, you'll receive the life insurance money. But if she does outlive you, like statistically happens in most cases, because statistically speaking, women live longer than men.
Mm-hmm.
If that is in fact the case, then one thing we want to do is we want to make sure that she has long-term health care, and the money that is in her life insurance policy, again, if she does pass before you, you'll receive the life insurance money. But if you pass before her and she ends up having a stroke or not, there's a bunch of different things. If you're not able to perform 2 out of 6 of daily living activities, so if you're not able to get yourself dressed,
Mm-hmm.
if she's not able to feed herself, if she's not able to get herself up and out of the bed by herself, if she's not able to shower
Mm-hmm.
or bathe by herself, any of these things can activate a long term care policy. And when I say, "Sir, what's most important to you?" and he says, "Well, my wife. And if anything happens to me, I want to make sure she's well taken care of." When I say, "Oh, all right, well, we have a policy that if she passes before you, will be life insurance money for you. But if she doesn't, whatever amount she has in life insurance, say 2 or 300,000, she could use for herself for long term care, and she can pay somebody to come in the house and cook for her, or to come in the house and bathe her,
Mm-hmm.
or she could pay for home modification, so a hand ramp or a rail or the chair that gets you up the stairs. We will put together contingency plans for if life happens and things that we didn't plan for happens. We don't want to get caught off guard, because the biggest thing that can really, really ruin a great retirement plan. I mean, we've got everybody on board. We know how much we can save, how much we should spend, how much we can spend without throwing the budget out of whack. And we're coming with the biggest thing actually that'll mess up and throw a monkey wrench in a retirement plan is an unexpected long-term care need. You
Mm-hmm.
know,
Yep, absolutely. I've seen that in my family. Absolutely.
so we plan for death often in the form of life insurance, but that thing that's in the middle where somebody doesn't die,
Mm-hmm.
but they need medical expenses. So now the money that we have for retirement is being spent on medical expenses, which two things. One, the medical expenses probably aren't going to necessarily stop. It's going to continue. But two,
Yep.
we're also draining our retirement resources. So now the other person or the other spouse may not have retirement money because they spent it on their loved one. It,
Mm-hmm.
it could it could really, throw a monkey wrench in the plan. So I encourage investors to use the app so that they could get some real life experience. Um, and I always kind of say, use your play money with that, and
Mm-hmm.
I'll invest we'll invest the serious money together.
Mm-hmm. I like that. I like that very much. And you bring up a good point. I actually spent some time working at a Black woman-owned accounting and investment firm, and I was really surprised to learn the different ways that life insurance products are used to build wealth. And I think a lot of times in our community, sometimes we're hesitant to have frank conversations about life insurance and what people will leave behind and what we have to deal with financially. What do you think? Why do you think it's important to have those conversations, and what tools can help people approach those sensitive topics?
Um, Boy, you're really hitting the nail on the head today. Um,
I do try.
it's I would say comfort
Hmm.
and confidence in the fact that it's an important conversation to have.
Hmm.
And I think you're right. Within some communities, ours in particular, the life insurance conversation is not comfortable for neither the kids nor the parents. And a lot of times it's not comfortable for the kids because they don't want their parents to think that they're trying to, get something from them or take something from them. And then a lot of times it's not comfortable for the parents because a lot of times I think the parents just kind of feel like Again, kind of just in our community, I think, as for my
Mm-hmm.
experience, a lot of times the parents are kind of like, you don't need to know what I have or what I've got left over
Mm-hmm.
for you. Whatever you get when I go is what you get. Hope that there's something there. Maybe there is, maybe there's not. It's a mystery.
And then we're all
Um,
surprised.
yeah, and you're surprised. And there's this kind of a feeling of whatever I did or whatever I made, and my kids, whatever they do, whatever they make, they'll make.
Mm-hmm.
And I'll admit, in the last year or so, there's been a lot of progress with that as well. I've had a lot of
Mm-hmm.
younger individuals come to me and say, you know what, Ryan, if something happens to me, I want it to be a game changer for my family.
Yeah.
Like I want them to have all the resources that they could imagine if something happens to me. And I think that that's amazing.
Mm-hmm.
There are some cultures that have believed in life insurance and have been utilizing life insurance for years. And that really helps in regards to getting a head start because instead of hitting the reset button with every generation, you pick up the spoon wherever it was left at and you keep on running towards the finish line.
Mm-hmm.
It's a much easier, much better conversation and situation than you hit the reset button every time. And a lot of times within our community, it's a reset button. You start from go. You start from
Yeah.
square one every time, and that's not good.
No, it is not good. It is not.
So yeah,
And thank
like
you, Ryan. Go ahead.
I'm sorry, last bit. Life insurance as a wealth, as a generational wealth tool is great and is underutilized. It should be
Yeah.
utilized more.
It should be utilized more. And is that something you are able to do? Do you do insurance at your firm?
Yes, yes. So, great question, good point. So, a lot of times, I think people kind of do think that as a financial advisor, you're looking to talk to them about securities or about investments, and I think that life insurance is a whole separate guy, a whole separate bag. But if we really just think about all of the components that go into a comprehensive plan, life insurance is definitely part of that comprehensive plan. I mean, going back to the conversation earlier, if we put together a really great retirement plan, we know what we're going to do and how we're going to do it. If somebody kicks the bucket a little bit sooner than we were planning, that may not be part of the plans here. We may have
Mm-hmm.
been counting on that person's income for another 10 or 15 years to get the savings that we needed for the goal. But if one person,
Mm-hmm.
passes a little bit sooner than what the plan was, we need a whole new plan. But yeah, life insurance helps with that. Long-term care helps protect the resources that we have. Um, and I think the biggest thing is a lot of times people are a little bit concerned or uncomfortable with the life insurance conversation because they think that it can get expensive, and sometimes it can, depending on the situation. But what's the best, most affordable product in regards to life insurance and not paying a huge amount would simply be term insurance.
Mm-hmm.
And I think a lot of times people don't realize that there's multiple different types of insurance, but term insurance
Mm-hmm.
is very affordable. It's very unique. It does not cost much. I mean, I ran a quote, I don't know, maybe a week ago for a guy somewhere around his 40s. We wanted to have $1 million life insurance, and I think his quote was like around $42 a month or something. And
Wow.
I think it was a 10-year term or it was a 15-year term. But term life isn't something that you use for the duration of your whole entire life. It's not an umbrella that's going to cover you from beginning to end in regards to your life
Right.
insurance. Term is something that's very specific for a unique period of time. So maybe you've got a child, the child is 5 years old, and if something was to happen, place your income until the child is an adult. So if the child is five, that's 13 years of income. So whatever is your income, we multiply by 13 years. And that's at least the amount of life insurance we want for your child. Because if something happens to you or to the person, whoever the case may be, we don't want that child's quality of life to be impacted. They already lost their parent. We
Right.
don't want them to be in
Exactly.
a financial situation that is, on top of the losing of a loved one. So life insurance is it's great. It's definitely great when it's in a space that's affordable. Like we were saying earlier, some cases if the individual, if the client just waited a little too long or waited in life once they've already had like a health scare or a health concern, Sometimes trying to add life insurance, when we're in our 50s or 60s is a little bit more challenging than adding it earlier. But the flip side is when we add it earlier, say in our 30s or 40s, we're probably not at the age where we may or may not need it. And it's like, well, if I'm 30, I'm not, unless something happens to me, I'm not supposed to be passing away soon. I should have another 20 or 30 years. So it's like, why buy life insurance now if it's expensive and I got to pay for it for 20 or 30 years? Well, term is the answer. Term is not
Mm-hmm.
expensive. It'll cover you for whatever time period you need. You're not going to feel like you're paying a huge cost or premium. And at the end of the term period, everybody walks away, no harm, no foul. You no longer have the insurance. There's no cost for letting it go. You basically rent insurance for as long as you need it. And then when you no longer need it, you let it go.
Mm-hmm. I see. And then the other is full life insurance.
The other would arguably be a whole life insurance. And there's a few different type of policies in between that. When it comes to a whole life, you can have, I think it's maybe around 3 or 4 main different types of life insurance policies. And then you've got term. So really, I would think of life insurance as 2 different types: term or whole life. Um, and term is great for younger individuals, again in the 30s or 40s, that have financial responsibilities that if something happens to them, they want to have covered. Term is great for that. For people that are looking for kind of what we were talking about earlier, like a generational wealth tool, like when something happens to me, I want regardless of how old I am, I want my family to inherit, a life insurance benefit. They will use whole life for that.
Mm-hmm. Good to know. You have given me a lot of information today, Ryan. And I hope you all listening out there, I hope this is valuable to you. If it is, and you want to talk to Ryan more, feel free to leave him a voicemail on the Anchor app. And Ryan, what other ways can people reach you?
Well, ironically enough, I feel that if I'm the person that manages your money, that I'm also the person you should be able to get a hold of when you need to. So I put my cell phone number on my business card. For the most part, nobody's really ever taken advantage of it, but the office number is 770-926-5503. My cell phone is 209-675-4092. My work email is ryan.j.walker@edwardjones. Um, so an email or a text or a phone call, whatever is clever. I mean, we're living in a day where everybody's kind of quarantined and pandemic. So traditionally, I'd be looking to do a in-face or in-person face-to-face meeting or conversation. But a majority of what my day looks like these days actually is doing a ton of WebExes or Zoom calls. So if somebody just has a question, feel free to shoot a text or a phone call. But if somebody's actually wanting to meet and talk about their financial situation or learn more about the Edward Jones process and how we work with our clients, then a Zoom meeting may be the next best thing.
Awesome. Well, make sure you all reach out to Ryan. Hit him up. I'm hitting him up. I'm trying to save every 2 weeks, and every chance I get the information he has. And of course, self-educate. You can go online, you can Google, you can read the books. But if you want someone you can ask, Ryan is available. Thank you all so much for tuning in to this week's episode of Hayes' Higher Learning. The song of the week I have chosen is Money Ain't a Thing by Jay-Z and Jermaine Dupri. I thought it was appropriate for the episode. And thank you all for tuning in. We're together. We are learning better, doing better, and being better. I hope you all have a wonderful week.